Could Treasury yields hit 6%? Should you buy now or wait? Let's talk about something big happening in the world of money, U.S. Treasury yields. More specifically, could we really see the 10-year Treasury yield hit 6%? That's what investment firm T. Rowe Price predicted late last year. And just recently, they doubled down on that call, pointing to new developments like Germany's government spending more money. Now, we're not at 6% yet, but we're getting closer. Over the past week, Treasury yields have jumped, and financial markets are feeling the heat. In this video, we'll break it all down in a simple, easy-to-understand way. 1. Why the recent jump in Treasury yields is making investors nervous. 2. Who's been selling these government bonds, and why? 3. What this all means for your own investments and savings. Why are rising Treasury yields making people uneasy? Usually, U.S. Treasuries are considered one of the safest places to park your money. When markets get shaky, people rush to buy them. That pushes Treasury prices up and yields, interest rates down. But that's not what happened recently. After President Trump announced new tariffs, investors initially bought Treasuries, as expected, driving yields down. But a few days later, something strange happened. Even as the stock market dropped further, Treasury yields went up instead of down. That's a big red flag. Let's look at some numbers. Over just 1 week, the 10-year Treasury yield swung from a low of 3.86% to a high of 4.5%. The 20-year moved between 4.35% and 5.05%, and the 30-year from 4.33% to 4.99%. That's a lot of movement in just a few days for something usually stable. And the fact that yields were rising even when stocks were falling made investors very uncomfortable. What's going on? Who's selling Treasuries? And why? If yields are going up, that usually means someone's selling Treasuries. But who? And for what reason? Let's go over the 3 main theories: tariff uncertainty and stagflation. Fears new tariffs introduced by Trump brought fears of a slowing economy combined with rising prices, also known as stagflation. That's a nasty combo for investors. To deal with that extra risk, they demand higher yields on government bonds. So, they sell off their current bonds, pushing prices down and yields up. Hedge funds exiting. Basis trades. Basis trades are complex strategies used by hedge funds to make small profits by buying and selling treasuries and related futures. When markets are calm, this works like a charm. But when things get volatile, these trades become too risky, and hedge funds back out. Right now, it's estimated that around $800 billion was tied up in these trades. If that money pulls out, demand for treasuries drops, prices fall, and yields go up. This happened once before during the early days of COVID in 2020, and it led to a massive bond market panic. Foreign investors pulling out. There's also talk that China may be selling some of its treasury holdings, possibly as a response to the new tariffs. And while China is still one of the largest foreign holders of U.S. debt, about $750 billion, that's only around 2.6% of all treasuries in circulation. So yes, it's a factor, but not the whole story. What's more interesting is that foreign funds overall pulled out about $6.5 billion from U.S. assets just last week. That might include investors from Europe or Japan selling treasuries and taking that money back home, especially into German government bonds, which saw a noticeable spike in demand and drop in yields. In short, whether it's China, Japan, or European investors, it looks like some foreign money is heading for the exits. So, could we really hit a 6% yield? Let's come back to T. Rowe Price's prediction, a 6% 10-year Treasury yield. That might sound extreme, but here's why it could actually happen. Government spending is still high. The U.S. continues to run large budget deficits. And the 2025 federal budget, though still being debated, is shaping up to add trillions more in debt. That means the government will need to issue more treasuries, increasing supply. When supply goes up and demand doesn't keep pace, prices fall, and yields rise. Inflation may creep up again. With more government spending and new tariffs in place, inflation might not come down as expected. And if that happens, the Federal Reserve might be forced to keep interest rates high. That would also put upward pressure on Treasury yields. Declining foreign demand. As we mentioned earlier, foreign investors are playing a smaller role in buying U.S. debt. A decade ago, they owned more than 50% of treasuries. Today, it's closer to 30%. If this trend continues, the U.S. may have to offer higher yields to attract buyers. What should you do with your money? If you're wondering whether to buy treasuries now or wait, here's the good news. You don't have to rush. If you're eyeing things like bonds, the rate is locked in no matter whether you buy now or at the end of April. If you're looking at longer-term treasuries, you might want to wait a bit longer. If yields really do keep rising, you'll get a better return later. But if you're risk-averse and want to lock in current yields, that's fine too. Just know they might go higher. This is a tough market, and even pros are scratching their heads. But understanding the why behind the recent yield spike can help you make better decisions. To wrap it all up, Treasury yields are spiking and could go as high as 6%. The jump seems to be driven by tariff fears, hedge fund selling, and foreign investors pulling out. If the U.S. keeps running big deficits, inflation lingers, and foreign demand stays weak, higher yields could be here to stay. Whether to buy now or later depends on your goals, but don't panic and stay informed. Thanks for watching, and stay tuned for our next update.